The UBS report forecasts a significant expansion in the humanoid robot market, predicting the presence of 2 million humanoid robots by 2035 and a staggering 300 million by 2050. This growth is expected to address labor shortages and support aging populations, with the market potentially reaching $1.4 trillion to $1.7 trillion by 2050. Key industries poised to benefit include global automation, auto parts, semiconductors, batteries, and rare earth refining. Companies like Nvidia, Honeywell, TSMC, Cognex, and Tesla are identified as potential beneficiaries, with Nvidia already unveiling AI tools to accelerate humanoid robot development. The implications of this growth are profound, as humanoid robots are expected to significantly contribute to global automation revenue and reduce costs due to economies of scale. The prediction aligns with recent advancements, such as Nvidia's AI tools and UPS's exploration of robots for logistics. Moreover, tech giants like Apple and Meta are reportedly entering the AI-powered humanoid robot race. As the industry evolves, these developments could reshape market strategies and influence global economic dynamics, signaling a transformative era for technology and automation sectors.
Nippon Steel has finalized its $14.1 billion acquisition of U.S. Steel, marking a significant consolidation in the global steel industry. This acquisition positions Nippon Steel as the world's fourth-largest steel producer, with crude production increasing to 57.82 million tons, drawing closer to China's An Steel Group. The deal, concluded after 18 months of negotiations and political hurdles, includes a golden share for the U.S. government, allowing it to veto certain strategic decisions like relocating headquarters or closing plants. This provision is part of a national security agreement, which also requires Nippon Steel to invest approximately $11 billion in the U.S. by 2028, focusing on production and trade commitments. The acquisition comes amid a challenging backdrop of U.S. tariffs on steel imports and declining domestic demand in Japan. Nippon Steel aims to capitalize on the anticipated growth in U.S. steel demand driven by infrastructure renewal and the electric vehicle sector. However, analysts express concerns over the financial strain of the acquisition and the integration challenges Nippon Steel might face, given its limited track record with large-scale operations without partners like ArcelorMittal. Despite these challenges, the deal is seen as a strategic move for Nippon Steel's long-term growth, although it has led to a cautious outlook on the company's stock due to increased investment costs and weak demand in its home market.
U.S. Steel and Nippon Steel have finalized a significant partnership agreement, marking a pivotal moment for the American steel industry. The deal, initially proposed in 2023 and delayed due to national security concerns, has now been approved under President Trump's administration. Under the terms of the agreement, Nippon Steel will invest approximately $11 billion in U.S. Steel by 2028, with commitments to maintain U.S. Steel's operational autonomy and ensure that key management roles remain occupied by U.S. citizens. This partnership is projected to generate over 100,000 jobs in the U.S., and a golden share provision grants the U.S. government veto power over major corporate decisions, safeguarding national interests. The partnership is set against the backdrop of heightened tariffs on foreign steel imports, which President Trump recently doubled. This strategic move is expected to bolster domestic steel production while reinforcing U.S. Steel's market presence. Despite the optimistic outlook, the United Steelworkers Union has expressed concerns regarding the long-term implications of the deal, emphasizing the importance of ongoing collective bargaining to protect workers' rights. As the partnership unfolds, it could significantly influence market dynamics, with potential ripple effects on global steel trade and domestic manufacturing policies.
Elon Musk's artificial intelligence startup, xAI, is currently experiencing significant financial strain, burning through $1 billion monthly as it develops its advanced AI models. This rapid cash burn underscores the substantial financial demands of the AI industry, particularly for xAI, which has yet to generate substantial revenue streams compared to competitors like OpenAI. Despite these challenges, xAI is engaged in aggressive fundraising efforts, seeking $9.3 billion in debt and equity to bridge its financial gap. The company plans to spend over half of this amount within the next 3 months, highlighting the urgency of its financial needs. Musk's venture is expected to expend approximately $13 billion in 2025 as it races to develop AI capabilities that can compete with its peers. The financial dynamics at xAI are reflective of broader industry trends, where significant capital is required to build AI infrastructure, including server farms and specialized computer chips. The Carlyle Group Inc. estimates that $1.8 trillion will be needed by 2030 to support AI infrastructure development. Despite the competitive landscape and substantial cash outflows, xAI remains optimistic about its future prospects. The company plans to leverage synergies from its recent merger with X, Musk's social media platform, to access vast data archives for training its AI models. Additionally, xAI anticipates profitability by 2027, buoyed by Musk's leadership and strategic investments in infrastructure. Investors, including Andreessen Horowitz and Sequoia Capital, have shown confidence in xAI, with its valuation rising to $80 billion at the end of the first quarter of 2025. However, the company continues to face challenges in securing favorable funding terms, as it seeks to maintain its ambitious growth trajectory amidst a highly competitive AI market.
Bayview Asset Management has announced its acquisition of Guild Holdings, a prominent mortgage lender, for $1.3 billion in cash. This transaction, which offers Guild shareholders $20 per share, a 56% premium over the pre-announcement stock price, will transition Guild from a publicly traded company to a private entity, with completion expected by the fourth quarter of 2025. Bayview, which currently holds a 7.3% stake in Guild, aims to enhance Guild's mortgage origination capabilities through collaboration with its affiliate, Lakeview Loan Servicing. The existing Guild management team will remain in place to ensure continuity in operations and strategy execution. This acquisition is part of a broader consolidation trend within the mortgage industry. Driven by high interest rates and limited loan growth, it follows similar moves, such as Rocket Company's $9.4 billion acquisition of Mr. Cooper Group, indicating a strategic shift among lenders towards mergers and acquisitions to enhance operational efficiencies and market positioning. Shareholders of Guild will benefit from a special dividend of up to 25 cents per share prior to the deal's closure. The transaction, advised by Morgan Stanley for Guild and Goldman Sachs for Bayview, underscores significant institutional support and is expected to influence the competitive landscape as smaller lenders seek stability amid challenging market conditions.
Investors are closely monitoring the Federal Reserve's forthcoming announcement, which is anticipated to significantly influence market sentiment across various sectors. The Volatility Index, VIX, indicates increased caution, suggesting potential market turbulence. Key indices, including the S&P 500 and Nasdaq, experienced slight gains of 0.1% as traders positioned themselves cautiously ahead of the Fed's decision. Analysts expect the Fed to maintain current interest rates, with a focus on future economic projections, inflation, and interest rate trajectories. The financial landscape is also shaped by geopolitical tensions, particularly between Israel and Iran, which have contributed to fluctuations in oil prices. U.S. benchmark crude and Brent crude both saw declines after earlier increases. In the commodities market, gold and silver showed mixed performances, reflecting investor uncertainty, while crude oil prices remain volatile due to global supply concerns. Sector-specific sell signals were identified in biotech, materials, and solar energy, indicating potential downward pressure. Meanwhile, corporate news highlighted Marvell Technologies' share rise after an AI event and a downgrade for Norwegian Cruise Line due to demand concerns. Verve Therapeutics stock surged following Eli Lilly's $1 billion acquisition deal. Globally, stock markets presented a mixed picture, with European indices experiencing modest gains, Japan's Nikkei rising significantly, and Hong Kong's Hang Seng Index falling. Concerns about U.S. tariffs impact Japanese auto exports, with a notable decline in exports to the U.S. The U.S. labor market showed signs of stabilization, but weaker than expected retail sales figures and decreased Treasury yields reflect broader economic uncertainties. As U.S. markets close tomorrow and Canadian markets anticipate reduced activity, investors remain cautious, awaiting further clarity from the Fed's stance.
The artificial intelligence (AI) sector remains a beacon of growth amidst a turbulent macroeconomic environment. with CoreWeave and C3i exemplifying the sector's resilience. Both companies have shown impressive year-over-year sales growth driven by strong customer demand for AI solutions. CoreWeave, which provides computing power for AI system development, reported a remarkable 420% increase in Q1 revenue, reaching $981.6 million. However, the company faces challenges with profitability and a significant debt burden of $8.7 billion, which could potentially hinder its long-term financial stability. On the other hand, C3i, which specializes in AI software for enterprise clients, has steadily expanded its business since going public in 2020. The company recorded a 25% revenue increase in fiscal 2025 and anticipates continued growth in fiscal 2026. Despite not being profitable, C3i's solid balance sheet, with total assets of $1 billion against liabilities of $187.6 million, positions it favorably compared to CoreWeave. Additionally, C3i's partnerships with major players like Amazon Web Services and Microsoft Azure enhance its market presence. Given these factors, C3i's more attractive valuation and sound financial footing make it a more promising long-term investment in the AI sector compared to CoreWeave.
The main financial event in focus is the anticipated increase in Social Security's cost of living adjustment, COLA, for 2026, predicted to be 2.5% by the Senior Citizens League, TSCL, an advocacy group for seniors. This adjustment comes amid rising inflation, which has been consistently higher over recent months, marking the fourth consecutive month of increased COLA predictions. The Social Security Administration adjusts benefits annually based on inflation, meaning higher inflation results in higher monthly benefits for recipients. However, while this increase is beneficial for recipients, it also highlights the ongoing challenge of inflation impacting the cost of living, particularly for seniors. Additionally, there are concerns about the accuracy of inflation data due to a hiring freeze at the Bureau of Labor Statistics, BLS, which has affected the quality of data collection for the Consumer Price Index, CPI. This has raised alarms among economists and advocates like TSCL, who fear that unreliable data could lead to COLA adjustments not fully reflecting actual inflation, potentially disadvantaging seniors financially. The Supreme Court's recent decision allowing the Department of Government Efficiency access to Social Security records further underscores the heightened scrutiny and administrative changes surrounding Social Security and inflation measurement. The broader implication is a continued debate on how best to measure and respond to inflation to protect consumer finances, especially for vulnerable groups like retirees.
The U.S. Senate is currently debating a significant tax and spending bill, dubbed the Big Beautiful Bill, which has sparked concerns over proposed changes to Medicaid funding. Senate Republicans, led by Majority Leader John Thune, are working to address opposition within their ranks, particularly regarding a reduction in the Medicaid provider tax rate from 6% to 3.5% by 2031. This change has raised alarms among some GOP senators, including Missouri's Josh Hawley, who argue that it could lead to the closure of rural hospitals, a critical issue for states that expanded Medicaid under the Affordable Care Act. The bill, which aims to raise the debt limit by $5 trillion and includes various tax policy reforms, faces a tight deadline with a planned vote before the 4th of July. Key elements of the legislation include making full expensing permanent, enhancing the R&D tax credit, and allocating funds for border security and infrastructure improvements. However, the contentious Medicaid provisions are proving to be a stumbling block, with senators like West Virginia's Jim Justice and Wisconsin's Ron Johnson urging more time for deliberation to ensure the bill's success. The House has already passed its version of the bill, but the Senate's modifications, particularly the Medicaid changes, are under intense scrutiny, potentially delaying the legislative process.
Advanced Micro Devices, Inc., AMD, is poised for significant growth, with projections suggesting its stock could reach $200 within the next 1 to 2 years. This optimism is driven by AMD's strong operational performance, highlighted by a 35.9% year-over-year revenue increase to $7.44 billion in Q1 and a 54.8% rise in earnings per share (EPS) to 96 cents, surpassing market expectations. Despite facing a $1.5 billion sales impact from China's export controls, AMD's data center and client segments posted impressive growth rates of 57% and 68% year-over-year, respectively, underscoring the company's robust operational foundation. The company's competitive positioning in AI, particularly with its MI350, MI355X offerings, and an expected 26.7% compound annual growth rate, CAGR, in EPS over the next 5 years, further bolster its growth prospects. Trading at 30 times its estimated earnings for FY26, AMD's fair value is projected to exceed $200, representing a potential upside of over 57%. A recent technical breakout above $115 suggests continued upward momentum, reinforcing the bullish outlook for AMD's stock. This performance positions AMD favorably against competitors like Nvidia, signaling strong future growth and margin expansion.